Everyone tells you to pay off your highest interest debt first. This is the standard advice you hear from every financial planner and budgeting app. It is known as the avalanche method. The logic is simple and mathematically sound. You save the most money over time by eliminating the most expensive debt before anything else. But what if one of your debts has a different kind of power? What if the creditor is not a bank but the government? This changes the entire equation. Most financial advice ignores this specific intersection. It treats all debt the same. But debt from the Internal Revenue Service carries consequences that credit card companies cannot match. Consider the standard rule. You have a credit card with 20% interest. You have a tax bill with a penalty. The math says attack the 20%. But the reality of enforcement is different. A credit card company can sue you. They can garnish your wages. They can report you to credit bureaus. But the Internal Revenue Service has the power to place a lien on your property. They can seize assets. They can freeze your bank accounts. This is not just about interest rates anymore. It is about survival. The research on consumer debt shows a complex picture. It is not just about math. It is about behavior and economics. Consumer confidence drives spending. When people believe the economy is strong, they borrow more. When it turns, they borrow more. When it turns, they borrow to survive. You might be using credit cards to pay for basics because your income has dropped. Then you miss a tax payment. Now you have two types of debt. The standard advice fails here because it does not account for the severity of government collection. Here is the thing about tax liens. They attach to everything you own. Your house, your car, your future assets. A credit card judgment usually targets current income. A tax lien follows you until you pay it. It makes selling your home difficult. It makes getting a loan impossible. The penalty rate is also steep. It compounds. While credit card interest is high, the IRS penalty can include failure to file penalties and failure to pay penalties stacked on top of each other. You might wonder why this advice is not common. There is a knowledge gap in the available literature. Most studies focus on behavioral patterns or credit scores. They look at how minimum payments trap borrowers. They look at how inflation drives debt levels. But they do not bridge the gap between general debt management and tax authority guidance. You are left to guess. You need to know that tax debt is treated differently in the eyes of the law. Now consider the psychological aspect. When you are in debt, you feel overwhelmed. You might delay the hardest task. Tax debt is scary. It feels bigger. This delay makes it worse. The Internal Revenue Service does not wait. They send notices. They escalate. If you ignore a credit card notice, you get a call. If you ignore a tax notice, the process moves toward legal action. This difference in urgency matters. It changes which debt you should prioritize. There is also the matter of scams. People with financial distress are targets. Tax scams are prevalent right now. Fraudsters call pretending to be the Internal Revenue Service. They demand immediate payment via gift cards or wire transfers. You must verify all communications through official channels. Do not trust a caller ID. Do not transfer money to a stranger. If you are unsure, hang up and call the official number yourself. This is a critical safety step before you even start your repayment plan. So how do you decide? If you owe back taxes, that debt takes precedence. The cost of a lien is higher than the cost of interest. You might need to set up an installment agreement with the Internal Revenue Service. This stops the penalties from growing as fast. Once you have a plan for the tax debt, you can focus on the credit cards. If you are current on your taxes but just carrying a balance, then you follow the standard rules. Pay the highest interest first. The tools available to you are changing. The Internal Revenue Service has introduced direct file and simplified tax tools. These reduce the friction of filing, but they do not resolve underlying debt issues. You still need a strategy. You need to prioritize high-interest credit card repayment strategies like the avalanche or snowball methods to avoid compounding financial distress. But you must do this without endangering your standing with the government. Generalist credit scoring models may inadvertently bias specific demographic groups. This can limit access to lower-interest refinancing options. If you cannot refinance your credit card debt, the interest rate stays high. This makes the tax debt comparison even more critical. You cannot always lower the credit card rate. You can often negotiate the tax debt. You can request a penalty abatement. You can propose an offer in compromise. These options exist for tax debt that do not exist for credit cards. This brings us back to the core question. Which debt kills you faster? High interest eats your wealth slowly. Tax liens can freeze your life. You need to weigh the speed of the damage against the cost of the interest. In most cases, the government debt is the priority. It is the anchor that holds the ship down. Credit card debt is the weight in the hold. You need to lighten the hold to float, but you cannot let the anchor drag you to the bottom. Financial education is the ultimate solution. But right now, you need a plan. Check your tax status. Verify any notices you received. Ensure you are not being scammed. Then look at your balances. If you have a tax lien or a significant tax bill, make that the primary target. If you are current, attack the credit card with the highest rate. Do not let the fear of the government paralyze you into inaction. Inaction is the only thing that guarantees the worst outcome. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.